Hello everyone. My name is Harshdeep Singh and I'm delighted to be your host for today's webinar on navigating compliances for NRIs, tax and regulatory perspective. Whether you are already living abroad or planning your journey overseas, today's session is designed to help you better understand the tax, legal and regulatory aspects of managing your affairs in India. Let's begin with a brief introduction about NRI Advantage. NRI Advantage is a dedicated advisory platform created exclusively for NRIs, non-resident Indians. Our objective is simple: to make managing your India-related tax, legal, banking, property, and documentation requirements seamless, without the bank, without need to travel back to India. By MBG, NRI Advantage combines cross-border expertise with a client-first approach, ensuring that NRIs receive end-to-end support through a single trusted platform. With the dedicated teams in India and overseas working together, we strive to deliver timely, reliable, and hassle-free solutions of our clients across the globe. At NRI Advantage, we provide a comprehensive range of services tailored to needs of NRIs. These include income tax return filings, advisory, assistance with tax notices, PAN and TAN services, overseas remittance through Form 145, earlier Form 15CA, and 146 Form, earlier called as Form 15CB, and legal advice, property due diligence, NRE and NRO banking assistance, will drafting, business incorporation, corporate compliance, and much more. Our goal is to ensure that every aspect of your compliance journey is managed professionally under one platform. At NRI Advantage, we built a simple and transparent four-step engagement process, that is consult, evaluate, execute, and deliver. This structured approach allows us to provide a seamless experience for our clients wherever they are in the world. It is now my pleasure to invite our first speaker for today's webinar, Mr. Janardhan Singh. Over to you, Mr. Singh.
Thank you, Harshdeep, for setting the context. Hello, everyone. We welcome you all in this webinar. In this session, we are going to cover provisions related to NRI taxation in India. So we all know that even if NRI individual moves abroad, they still have India source income, such as rental income, dividends, interest income, and capital gains, in addition to their foreign source income outside India. The taxability of various sources of income depends primarily on the residential status of an individual in a particular financial year, that is from the 1st April to 31st of March. Residential status needs to be determined every year for income tax purposes. Basically, conditions determining residential status are different for income tax and FEMA compliances. Residential status of an individual as per income tax is broadly determined on number of days stayed in India, whereas conditions as per FEMA will be covered in the next session by my colleague, Mr. Love. So let's look at the type of residential status. Broadly, every individual is either resident or non-resident. Resident individual can further be divided into resident but ordinary resident and resident but not ordinary resident. Accordingly, we can say that residential status are broadly of three types: resident, ordinary resident, resident but not ordinary resident, and non-resident. Now, let's focus on the rules for determination of residential status. To become resident in India as per income tax, there are two basic conditions. Basic condition 1, if an individual stay in India for 182 days or more, he becomes resident. Now, condition 2, if an individual is not in India for 182 days or more days, but present in India for 60 days or more in current financial year and 365 days in last 4 years, he will be considered as resident for income tax purposes. However, there are two exceptions to the basic condition number 2. Indian citizens traveling outside India for employment and as a crew member, and Indian citizen and person of Indian origin visiting India and have Indian sourced income up to 15 lakhs in a particular financial year. So these are the two exceptions to basic condition 2. Once an individual becomes resident, we can move to step 2 to check additional conditions. Condition 1, resident in at least 2 years out of last 10 years. And condition 2, stay of 730 days in last 7 years. In case both additional conditions are satisfied, an individual becomes resident and ordinary resident, otherwise shall be considered as resident but not ordinary resident. Further, in case presence is between 120 to 181 days plus 365 days or more over the preceding 4 years, and Indian income above 15 lakhs, if all these 3 conditions are satisfied, residential status shall be resident but not ordinary resident instead of non-resident. There's also a deemed resident rule. An Indian citizen with Indian income above 15 lakh who is not liable to tax anywhere abroad can also be considered as resident but not ordinary resident in India, and such persons are commonly known as stateless person for income tax purposes. In case of NRIs, treaty also plays a very important role. Sometimes India and host country claim an NRI as a resident under respective domestic laws. That's where the tax treaty steps in with a tiebreaker applied in a very fixed order. First, where is your permanent home? If that's inconclusive, your center of vital interest, your personal and economic ties, then your habitual abode, and finally, your nationality with a mutual agreement procedure as the last resort. Basis these provisions, residential status is determined. The treaty also provides reliefs by way of concessional rates, exemptions, and foreign tax credit. To claim these reliefs, NRI must obtain a tax residency certificate from a country of residence, file Form 41, earlier Form 10F, and provide no permanent establishment declaration. Now, let's map how India taxes each head of income for an NRI. Salary is taxed where the services are rendered and where the salary is received. In case services are rendered in India as well as received in India, with the standard deduction of 75,000, it will be taxable in India. Rental income is fully taxable but reduced by 30% of standard deduction, and deduction for home loan interest is also allowed, but the tenant is required to do withholding by way of deduction of TDS. Business and professional income is taxed only to the extent it is attributable to an Indian business connection. And one important thing, presumptive schemes are not available to non-residents, so tax is on actual profits of the non-resident. Capital gains on Indian assets are also taxable basis the period of holding, either as a long-term or as a short-term capital gain. Long-term equity taxed at 12.5% above 1.25 lakh, and similarly, other long-term gains are taxed at 12.5% flat. Other sources income such as interest, dividends, royalties are taxable. However, NRE and FCNR interest stays fully exempt while you remain a non-resident. Let's put these 5 heads together into a practical plan. First, map every income stream to its source. Tax depends on whether income is earned or received in India. Second, capture your deductions and reliefs. The 75,000 standard deduction on salary, 30% house property deduction, home loan interest will reduce your taxable income in India. Third, structure your accounts very wisely. Hold foreign earnings in NRI or FCNR accounts for tax-free interest and route all Indian sourced income through an NRO account. So you have to be very careful that which income you are getting in which type of account. Fourth, apply for a lower or nil TDS certificate and also use 1.25 lakh of equity exemption alongside reinvestment reliefs which are there. Fifth, use the treaty, file your returns correctly, and claim foreign tax credit wherever applicable. Now, let's look at when one need to file income tax return. There are few triggers which makes it mandatory to file ITR, such as Indian income before deductions crosses the basic exemption limit. In case of refunds where TDS has been deducted in excess to your actual tax liability, and in the cases of carry forward of losses, also you are required to mandatorily file the income tax return. The basic exemption is 4 lakhs under the new regime and 2.5 lakhs under the old regime. And these exemption limits are also applicable in case of NRIs. However, in case of NRIs, no senior citizen concession is allowed. I would like to highlight that the rebate that makes income up to 12 lakh effectively tax-free is available only to residents and is not applicable in case of NRIs. So this fact we have to keep in mind. And the due date for filing of ITR is 31st of July in most of NRI's case. And NRI is not required to file ITR when two conditions are satisfied simultaneously. Only income for the year was invested related to investments or long-term capital gains. And in this case, investment income includes interest, dividends, and gains on specified Indian investments acquired in convertible foreign exchange, but excludes any kind of salary and business income. Now, let us know which income tax return form is applicable in case of NRI. There are two forms, and the dividing line is Indian business and professional income. NRI can use ITR 2 if don't have business or professional income. It covers salary, pension, capital gains, more than one house property, interest and dividends. And in case you have any foreign assets, that also you can report in Schedule FA. Whereas use ITR 3 in case of business or professional income. So we can say that a simple rule of thumb is that no business income, ITR 2, business income, ITR 3. Getting this right genuinely matters because the wrong form can render your return defective and forcing you to redo it. Let's pin down the deadlines and the cost of missing them. 31st July is ITR filing due date in non-audit cases, mostly in most of the NRIs cases. But there is a requirement of advance tax in installments where your actual tax liability exceeds 10,000 rupees. Form 145, earlier Form 15CA, and 146, earlier Form 15CB, must be filed before repatriation of funds abroad. And if any notice arrives, reply on the e-proceeding portal within the stated window, because there are strict timelines which are given to respond over the e-proceeding portal. And missing the filing deadline cost you a late fee of up to 5,000 and interest also at the rate of 1% per month. Recently, an amnesty scheme has been introduced for those who haven't fully disclosed foreign assets or income. So this scheme has two categories. Category A covers complete non-disclosure, foreign assets or income never declared and never taxed in India, where the aggregate fair market value is up to 1 crore as on 31st of March 2026. In this case, levy is 60% of fair market value, 30% tax and 30% penalty, with full immunity and no reopening of assessments. However, in category B, which addresses technical omissions, where the income was previously taxed, but the asset was left off in Schedule FA, means income is properly taxed, offered to tax, but it has not been disclosed in Schedule FA. So in this case, the limit for the fair market value is up to 5 crores and it can be regularized with a fee of 1 lakh rupee, resulting in full immunity from Black Money Act, penalties and prosecution. Let's now move to few case studies for better understanding. Rohan is a UAE resident NRI. During financial year 2025-26, he sells listed Indian shares held 3 years for a 15 lakh long-term gain, and an Indian flat or property held 6 years for 40 lakh long-term gain. How he is going to be taxed? Under the Income Tax Act of India, both are long-term. The shares at 12.5% above 1.25 lakh exemption, and house property shall be taxed at 12.5% but without indexation. Indexation of 20% means with the tax rate of 20%, option is not available for non-resident Indian. It is available only to residents. Buyer deducts TDS on sale, and along with the tax, surcharge and cess is also applicable. The good news is that NRI can reduce the gain using reinvestment reliefs. There are various exemptions which are available in domestic law. Now, in case of NRI, we have to evaluate tax treaty also. So under India-UAE treaty, India keep its right to tax immovable property. So there's no escape on the flat. And gains on Indian company shares are taxable in India. So the treaty offers no escape or no beneficial provision when it comes to the taxability of these two income. So, as we know that there is no personal income tax in UAE, and there is no double tax and no foreign tax credit to claim. So simply we can say that in order to claim treaty benefit, which is not automatic, one has to do certain type of compliances which may not be required in this case, because treaty is not giving any kind of benefit in this case. Move to next case study. Samir is a UAE resident NRI, has 4 Indian income streams, 5 lakhs of rent, 2 lakhs of NRO interest, 1.5 lakh of NRI interest, and 1 lakh of dividends. The rent is taxable after the 30% standard deduction with TDS. NRO interest is fully taxable with TDS at the rate of 30% plus surcharge and cess. NRE and FCNR interest is exempt, while he remains non-resident. And dividends are taxable with TDS at the rate of 20%. Now, treaty can help in this case. The India-UAE treaty caps dividend tax at 10%, which is below the 20% domestic tax rate. And it also caps interest, which is below the 30% rate on NRO rate. To claim those lower rates, he needs a UAE tax residency certificate, Form 41, earlier Form 10F. For financial year 2025-26, it is Form 10F. And since the UAE has no income tax, treaty relief simply caps the Indian rates. There's no foreign tax credit to claim in this case. With this, I end my presentation from tax perspective. Thank you once again for joining. Over to you, Harshdeep.
Thank you, Mr. Singh, for insightful session from tax perspective. Now I would like to invite Mr. Love Malhotra to take us through regulatory aspect related to NRI. Over to Mr. Malhotra.
Thanks, Harshdeep. Hello, everyone. Like my colleague, Mr. Singh mentioned very categorically about the importance of residential status under the tax regime. Let me tell you that the residential status under the provisions of Foreign Exchange Management Act gains equal importance. Now, when an Indian citizen becomes resident of an overseas country, the provisions of FEMA comes into picture, as per which there are 4 key operational areas. Previous slide, please. Cross-border movement of money, foreign exchange transactions, overseas investments, and repatriation of funds. If while executing any transaction, any of these 4 areas are triggered, the transaction would fall strictly under the provisions of FEMA. So the thumb rule is, your FEMA residential status determines which bank account you may hold and operate. So you can be an Indian citizen, but from a FEMA perspective, your legal status changes the moment your geographical intent changes, irrespective of the fact that you move for employment, business, or indefinite stay. Let us consider an example wherein an Indian citizen employed in Dubai, or maybe an Indian student pursuing a 2-year diploma course in the US. All know they both are Indian citizens, but due to their physical relocation, FEMA would recognize them as person resident outside India. Similarly, consider a German national coming to India on an employment visa. So technically he is an expatriate or an international worker, but under the provisions of FEMA, he will be regarded as a person resident in India. Next is when an Indian citizen who has been staying in Singapore for work or employment decides to move back to India permanently. So she cannot just keep his or her overseas saving in regular Indian saving bank account. Under FEMA, he or she needs to open a resident foreign currency account. Let us now move to next slides to gain further understanding on various foreign currency accounts. The most common of the lot is NRI account. Now, NRI account is basically maintained in Indian rupees. This means any foreign currency remitted into the account gets automatically converted at prevailing banking rates upon its arrival. It is strictly available to NRIs and OCIs, and the funds in NRI account is fully repatriable. Now, next question is what can be credited? So, overseas salary, foreign remittances, transfer from other NRI accounts, or NRE or FCNR deposits, and maturity proceeds of investments are some of the incomes or remittances which can be credited in NRE account. Now, what can be debited? So, any investment made in India, any local expenses, any transfers abroad, or remittances outside India can be debited from NRE account. Now, an NRI who returns permanently to India to settle down, but he forgets to notify his or her bank, this can lead to a common FEMA risk. This is nothing but an immediate FEMA violation. So the moment your geographical intent shifts from overseas country to India, your legal status changes to a resident. As an NRI, you are therefore legally obligated to immediately redesignate that account to either a resident foreign currency account or a standard domestic account. Next one is NRO account. Well, the core purpose of an NRO account is exactly the opposite. Now let us understand first what can be credited in the NRO account. So the typical credits would include the rental income, pension, interest income, sale proceeds, dividend income, or if there is any gift or loan taken by a NRI from a resident. These are permissible typical credits. Now from NRO account, as an NRI, you can transfer these funds abroad, but the repatriation is strictly subject to a threefold compliance check. First is, it must be within the applicable FEMA requirements, that is specifically the standard USD 1 million remittance per financial year for NRIs. Second is, if it requires adherence to the tax compliances, ensuring that all domestic withholding taxes or capital gains taxes have been fully settled before the capital is sent out abroad. Third is, it requires rigorous banking documentation, including but not limited to chartered accountant certificates. Now to conceptualize and carve out any doubt whatsoever, let us look at two practical case studies that would demonstrate how the NRE and NRO account framework actually works for NRIs. Next slide, please. Now, let's start with NRE account case study. So let's consider a person, Rohan, who is working in a company in Dubai and earns a salary of 15,000 dirhams per month. Now he wants to route his foreign salary to India, but requires the flexibility to transfer that money back to Dubai or any other country, maybe on a later occasion. So what's the way out for him? For this, NRE account is the optimal choice. His foreign earnings are remitted and maintained in Indian rupees, keeping both the principal and interest fully repatriable. So this becomes an ideal and tax efficient mechanism for foreign earnings, allowing seamless movement of capital back abroad while the interest earned remains tax-free in India. Let us look at the second case study now. This is for NRO account. So consider another NRI, let's say Mr. Sumit, who has been living in Canada, who owns a residential flat in Bangalore, from which he gets a monthly rent of, let's say, INR 40,000. Additionally, he receives a corporate dividend income from his Indian share capital portfolio. So which account is best for him? As his income originates strictly within India, it cannot have benefit of NRI account, right? So he routes these inflow directly into a NRO account, where taxes are deducted at the source, and he uses his local rupee to cover his Indian maintenance charges and maybe some utility bills. So NRO account in this case would be the best framework for managing his domestic expenses through local income, with an option to remit surplus funds back to Canada. Let us now move to FCNR. Now, a foreign currency non-resident deposit account, what you call as FCNR, is maintained in freely convertible currencies such as US dollars, pound sterling, euros, Japanese yens, etc. Why many NRIs prefer FCNR? For the simple reason that the deposit remains in foreign currency. So let's say, for example, an NRI who earns a USD 100,000 annually. What are the options available to him? First option is he can convert into INR and keep it in NRI account. The second option is he keep this in USD through FCNR account. So if the exchange rate changes significantly, the outcome can actually be very different. So FCNR helps avoid immediate currency conversion risk. Now you all must be aware, in the month of June this year, RBI came up with a new notification allowing NRIs to avail benefit of swap facility being generated to AD banks. This scheme is valid from 8th of June to 30th September, and the tenure is minimum 3 years and maximum 5 years, with of course a 1-year lock-in period. So here, RBI, by not charging currency hedging cost from AD banks, is basically allowing AD bank to pass on the benefit to NRI account holders. And resultantly, if NRI was getting an interest rate, let's say of 4 to 5% on their FDs, they will get an additional 2 to 3% because of this passing on of new benefit from RBI to AD bank. So FCNR is an optimal choice for NRIs who wants to maintain their funds in USDs. Next on my list is RFC account. Next slide, please. Now, RFC account is for returning Indians. So individuals who are NRIs and have returned to India permanently can open RFC account. Why it's important? Many returning professionals who have foreign savings, overseas investments, foreign pensions can use RFC account to continue holding eligible foreign currency assets after returning to India. Let's say that a professional returning from Singapore after 15 years of employment, can this accumulated USD savings be retained? The answer to this is yes, through an RFC account. Now, after understanding gained on previous slides, we kind of understand about the foreign currency accounts which an NRI can open. Let us now quickly understand the difference between them by way of the comparison. So as you can see on the slide over here, there are primarily 4 types of bank accounts based on currency, ease of repatriation, and user eligibility. So for NRIs looking to manage funds in rupees, there are NRI and NRO accounts. The difference between both of them lies in repatriation. While NRI accounts hold foreign earnings converted in rupees and are fully repatriable, on the other hand, NRO accounts manage the India-sourced income, and repatriation is subject to strict regulatory limits of RBI. Second is FCNR account, which I just mentioned eliminates exchange rate risk entirely, as it allows NRIs to hold fixed deposit directly in a foreign currency, which of course remains fully repatriable. Finally, for our returning residents, the RFC account is an essential tool. It allows individuals who are permanently returning to India to maintain their hard-earned, foreign-earned overseas funds in a foreign currency with full repatriation flexibility. Now, honestly, it may not be easy for people to conveniently recall these legal frameworks. So there must be a decision rule, isn't it? As you can see over the screen, there are 4 vital questions which an NRI must ask himself or herself before deciding on how to make the investment and which account to be used. Am I a resident or non-resident? Is the income generated in India or outside India? Do I need repatriation flexibility? Do I want to avoid exchange rate risk? Slide please. Now next is key documentation. Well, in my opinion, it is not only for an NRI, but everyone should always have robust documentation for all the transactions relating to their assets or liabilities in India or abroad. Now, when it comes to NRIs, I would divide the documentation requirement under 5 broad categories. As you can see on the screen, the first one of the lot is identification and residential status documents, such as passport, visa, residential permit for people residing in Dubai, Emirates ID, travel records, tax residency certificate, etc. Second is banking and investment documents. The examples could be your FD receipts, demat account certificates, insurance policies. If you have made any investment in shares, then share certificates, loan agreements. Third of the lot is property documents, such as sale deed. If you have got the property from a governmental authority, then allotment letter. If you have bought the property from, let's say, a builder, then builder buyer agreement, tax payment receipts, stamp duty and registration records, valuation reports, inheritance or succession documents. Next is tax and regulatory documents. So the examples could be income tax returns, TDS certificates, advanced tax challans, lower withholding certificates, which my learned colleague explained a little while ago. Last but not the least is estate planning documents. The examples could be wills, power attorneys for property or financial matters, surviving member certificates, relinquishment deed, trust documents, marriage certificates, birth certificates, etc. Now, before I end my session, I would like you to take some key takeaways from today's session. I would like to request you to kindly remember these 5 rules. First is, FEMA residential status determines which bank account to be used. Second is, when you have foreign income, NRI account is best choice. Third is, when you have Indian sourced income, think about NRO account. Fourth, when you go abroad or return to India permanently, you need to redesignate your bank account immediately. And fifth is to maintain robust documentation. That's it from my side in today's session. Thank you for your patient listening. Over to you, Harshdeep.
Thank you, Mr. Malhotra, and thank you, Mr. Singh, for sharing such valuable insights with us today. We hope this session has helped you gain better understanding of the tax and regulatory considerations applicable to NRI. If you would like to know more about NRI Advantage or require personalized assistance with your India-related tax, legal, FEMA, property, banking, compliance aspect, please feel free to connect with our team. We would be delighted to assist. Thank you once again for joining us today. We appreciate your time and participation and look forward to welcoming you to our future webinars. Have a wonderful day.